Okay, episode number 323, tax planning. So I want to give you a little bit of context as to how this particular show came to be. But before I do, I think we should probably just set the stage for the world that we live in right now. I mean, taxes are at an all-time low, debt is at an all-time high. And I think the question everybody's asking is, is that sustainable? Or is it possible that tax rates are going to stay low? Or is it likely or probable or possible that they could go up in the future? But the reason that this show came to be was because I had some folks come in and we were doing some retirement planning, and in their specific situation, we looked at two different scenarios. We looked at, because they had their money split pretty evenly actually between Roth accounts or traditional IRA accounts. And so we were playing with the numbers, and we looked at initially what they had thought they wanted to do was start taking money from their Roths the first couple of years of retirement and postpone taking money out of the traditional IRAs. So we built the cash flow plan based on that assumption. And then we just said, okay, now let's test this scenario. Let's see what happens if we take money out of the traditional IRAs first and leave the Roth IRAs till later. And what we found was that their money actually ended up lasting about 4 years longer than it would have. So that's pretty significant, just by thinking about the order that we're going to be taking money out of your retirement accounts can really make a significant difference in how long your money lasts. Now, a couple things I want to say as we talk about taxes. First of all, taxes are unique. Think of it like a fingerprint. It's going to be unique to you. So, of course, anything we talk about about taxes as it relates to your specific situation, you really need to sit down with your financial advisor, your CPA, and make sure that the tax strategy that you're implementing for your situation is best for your situation. So as we continue to set the stage and talk about taxes, let's look at the economic environment that we're in. Our national debt is currently $26 trillion. In 2016, the national debt was $19 trillion. In 2008, the national debt was $10.5 trillion. In the year 2000, our U.S. federal debt to GDP was 56.64%. Now, our U.S. federal debt to GDP is 136.63%. Due to COVID, the coronavirus, the federal costs this year, the coronavirus cost us about $2.4 trillion. And what's significant there is if we throw these numbers around, $1 billion, $1 trillion. Apple just became a $2 trillion company. What does $1 trillion mean? Well, if you were to give away $1 million per day, $1 million per day, it would take more than 2,700 years to give away $1 trillion. Think about that. Our national debt is currently $26 trillion. So the other thing we need to be thinking about is, well, how is this debt going to be reconciled? How are we going to deal with it? Does debt matter? Are we going to increase taxes in the future? Are we going to cut spending in the future? Are we going to try to grow our way out of debt? Are we going to try to spend our way out of debt? I mean, what is the solution to this? Or, some economists today say debt doesn't matter as long as we have the ability to print money in our own currency. Some people would argue that debt doesn't matter, and they point to a place like Japan where the debt to GDP is over 200%. But I believe that debt does matter. I think that there are consequences, long-term consequences to debt. And so one of the things we want to be thinking about in the context of the world that we live in is, what are the opportunities to capture as a result of the debt that's been created, and then the fact that back in 2017, we had the Tax Cuts and Jobs Act passed, and now we have some of the lowest marginal tax rates of my lifetime. And the fact is that these tax cuts are going to expire in 2025. A significant portion of Americans' wealth is tied up in 401ks, IRAs, TSPs, 403bs. All of these accounts are tax deferred, meaning that you didn't pay taxes at the time of the contribution. In many instances, you received a tax deduction at the time you made the contribution. The money's growing tax deferred, and it's going to come out, and when it does, you're going to have to pay taxes on those dollars at a future point. The question we need to be asking is, do we think taxes are going to go down in the future? If you think that taxes will go up, then this is simply a matter of buy low, sell high type of tax planning arbitrage. Taxes are low, we can pay taxes now, get money out of those tax hostile accounts and over to tax-free accounts. And I'm going to talk in more depth here in just a minute about the idea and the opportunity of doing Roth conversions. Not just Roth conversions, but I just started thinking about taxes. And so I just wanted to kind of do a brain dump. I just wanted to plant some seeds here for you, not to go on a deep dive into each one of these different areas, but just to give you some things to think about if it's important to you, do some tax optimization as you're planning for retirement. Now, a couple things to remember. The tax code is written in pencil, meaning that these guys that develop the code can change the tax code. We've seen 2 significant tax changes happen just in the last 12 months. Or 18 months, I guess I should say. So taxes can change, the tax law can change. And there's nothing to say that just because we do tax planning today based on what we know to be true, that the tax environment could become more favorable in the future, or it could become more hostile. We could end up with something like a national sales tax, where instead of taxing income, they tax us when we spend. And so then those Roth dollars would get taxed as you're spending them. But what we know is what we know about the way the world works today, and that's all we have to make decisions with. Some people will say, Jason, what does your crystal ball say? And I always say, I don't have a crystal ball, but we do have a financial plan. And a financial plan is probably the closest thing that we have to a crystal ball. It allows us to say, if we make decisions today and then look out into the future and say, what are the implications? What are the consequences? What are the opportunities to capture? What are the risks to avoid? And having a plan helps us model what the future might look like. That's the closest thing I know to a crystal ball. So as we start to dive into this topic about tax planning, there are several ideas I want to share. Number one, we've got to talk about the Secure Act and the CARES Act, just very briefly. Talk about tax-savvy withdrawals, where you live matters, health savings accounts, Roth conversions, reverse mortgages for tax-free income, Social Security for tax-efficient income, keeping income low for the Affordable Care Act and for income-related Medicare adjustments, charitable giving, and then transferring wealth to from generation to generation. Now, if this is a subject that's of interest to you, something you want to learn more about, I'm going to include in the show notes links to some previous interviews I conducted just recently. Number 230, I interviewed Robert Keebler, who's a CPA, and we talked all about the Secure Act that was passed in December of 2019. Episode number 232, I had tax and estate planning attorney, Tony Hinson, on the program. And we talked about the opportunities that exist as a result of the Secure Act and things that people probably need to change or may need to change based on that tax change that took place. One of the neat things about Tony is not only is he an attorney that specializes in tax strategies for high net worth families and people with large IRAs and estates, but his background was that he worked for the IRS. If you're interested in learning more, I highly recommend you go back and listen to episode 232. If you have more than a couple $100,000 in a retirement account, it'd be a good one for you to listen to. Episode number 308, I did a very comprehensive show on the CARES Act and everything that was taking place there. But there are a couple of things that I want to touch on between the Tax Cuts and Jobs Acts, the Secure Act, and the CARES Act. Number one, the TCJA, the Tax Cuts and Jobs Act, gave us very low tax rates until 2025, at which time those tax rates are scheduled to sunset. Right now, we have until 2025 to really take advantage of these really low tax rates. The next thing is the Secure Act changed the date for required minimum distributions. It used to be at 70 and a half, you had to begin taking minimum distributions. Now we don't have to take minimum distributions until age 72. So you basically have another 18 months to allow that money to grow tax deferred or to do Roth conversions before we have to begin taking required minimum distributions.